Chapter 1. Introduction to Day Trading. If I think the value of a stock in the market is going to go up under some financial market conditions, I am obviously going to buy it. In the same vein, if I think the value of the stock is going to come down, I will be smart not to invest my money going forward. Day trading thrives on speculations with the holders of securities, being very careful not to miscalculate, to avoid unnecessary loss. The people in this type of trading are referred to as speculators. People who are ignorant of how day trading works refer to them as gamblers. But in this book, you're going to learn why day traders are never gamblers, and why gamblers are never day traders to begin with. In the earlier days of day trading, only registered financial institutions were able to trade actively. However, around the 90s, when electronic trading platforms became popular in the U.S., commoners leveraged on this opportunity and started day trading. Today, day trading is available to everyone who is willing to do what it takes and to learn about it. Day trading, literally, is any assumption underlying the specific buying and selling of financial services, which is started and completed within the same day. The key word here is same day. That is, everything is going to be happening in a day. Let's say you buy your stocks at 9 a.m. on Monday morning. Then you sell the same stock at 4 p.m. of the same day. If I buy a stock for $750 today, and the stock lasts tomorrow before I'm able to sell it off, then this is not regarded as day trading. This is 2 days trading. Day trading can otherwise be referred to as any opening financial transaction closed out in part or in full on the same day. Day traders close their market before the start of another day's transaction. This is to ensure they don't fall victims of any risk of price fall, which leads to loss. Some day traders make just 1 day trading per week, while others make 2 or even more than 2. In the United States, day traders who make over 3 day trading per week are called pattern day traders. Pattern day traders must have around $25,000 in equity worth in their account to maintain trading. 3 things particularly make day trading the talk of the financial market in the United States. The 1975 Commission Amendments, deregulation of commissions in the United States through regulation of fixed commission rate, the introduction of electronic trading platforms through communication networks, and volatility of stock price. Basics of day trading. Mere looking at the word itself, day trading looks like it's clear-cut and risk-free. Actually, day trading is not as easy as it seems, especially if you don't equip yourself with great books that can give you the basic guidelines of the day trading business. To sail through, let's familiarize ourselves with some of the basics of day trading. A. Minimum capital needed for day trading. The United States Securities and Exchange Commission, SEC, stipulated a minimum of $25,000 in your equity account. This is to maintain business and to keep you running. B. Choose your day trading market wisely. You should try as much as possible to avoid divided attention. Focusing your energy on one market type and trying to know everything about the market is key. This will enable you to plan your strategies to be successful in the market. It is far better to learn how to make money in one market and then making the money than it is to learn about 5 different markets at a time without getting results. You can select from any of these. Day trading stocks. You need about $25,000 to get started. It is more capital-based. Stocks usually trade in what we termed around lots, or orders of at least 100 shares. To buy a stock priced at $50 per share, you will need $5,000 in your account. A broker may let you borrow up to half that money, but you still need to come up with the other $2,500. Future markets. Trading in accessories such as gold, crude oil, etc. requires about $1,000 to start. In this market, a contract stands for some unit of the underlying security. In the options market, one contract goes for 100 shares of the stock. These contracts also specifically trade in round lots of 100 contracts per order. Forex market. Selling in euros and dollars. You may get started with $50 or more. This is not particularly capital intensive. This is arguably the biggest day trading platform. Here, countries come together on an international platform to trade, mainly for exchanging currencies against another. This will be discussed further in the subsequent chapters. C. Basic tools needed for day trading. Have you ever come across a successful farmer without his farm tool? I can bet in the negative. To start day trading, you'll need some software and equipment to get started. Computers. Having a laptop, Mac, or iPad device is one requirement which is unavoidable. There are many trading software and programs which are only run on computers. The computer must have a very fast processor and enough RAM. You can't afford to get logged out during trading sessions. Superb internet connection. You must invest in a very stable internet connection. This is necessary to be able to update your trading platforms as often as possible. Trading platform. You must be conversant with as many trading platforms as possible, and you must select the one that's best for you. Trading platforms are available for download. This service is usually provided by brokers who charge for the service. D. What time is best for day trading? Maintain an aura of consistency by following the same routine engagement every day. If you are trading in Forex, it is best to trade within the first 1 to 2 hours of opening the market and the last 1 hour of closing. If you're a future day trader, it's advisable you trade in the morning as soon as the market is opened. Day trading is best between 8:30 a.m. to 11 a.m. Eastern Standard Time. Forex trading, around 7 a.m. to 10 a.m., produces the best pricing. The trading schedule will be discussed further in chapters to come. Different types of trading. Active traders understand the importance of having methodologies that would, at best, bring long-term financial stability. Much will be said in the latter chapters about some of the technical analysis indicators used by traders, particularly the day traders. The sole aim of any trader is to make profit while not losing customers. It then becomes imperative for beginner traders to develop proactive strategies to ensure they build their brand in the market. First, we have to explore the 3 very important types of trading. The 3 types of trading include intraday trading, day trading, and swing trading. One noticeable difference between them is the timing of opening and closing the markets. Intraday trading. Intra literally denotes within. So judging by the name itself, you can always tell that intraday trading means a transaction within a day where you buy and sell any security from the moment the market opens and just before the market closes. The transaction must be done and completed by the end of the day before the market closes. In a case where you buy securities, then settlement is to sell the same before the market closes. You can either buy the securities first and then sell, or you sell your securities and then buy another. This settlement is called square off. So in simple words, intraday means squaring off your open contracts. This means if you've procured a certain amount of stock, you have to sell it. And if you have sold out a particular quantity, you have to buy it. If you do not do any of these, your position on the daily market will automatically square off. To have an effective intraday trading, you should Pick stocks which has more interested buyers and sellers. Always be updated about happenings in the market. Do your research before getting started. Don't trade in penny stocks. Don't take decisions without knowing what you're into. Seek expert advice when needed. There are a few trading strategies being deployed by intraday traders: order flow analysis, scalping, high-frequency trading, etc. Order flow trading. This is a method that seeks to anticipate any price movement based on current orders that are observable on both the buy and sell side. An order flow is the mechanism that moves prices up and down in the market. It is literally the balance or imbalance of buyers and sellers. It's the onslaught of market sell orders that tend to stress the buy limit orders, or the market buys that stress the limit order sellers. Scalping. This is a method of trading that thrives on real-time technical analysis. When you talk about trading, scalping generally refers to making a huge number of trades, such that each trade produces small profits. Rather than holding on to a position for several hours, days, or weeks, the main goal of scalping is actually to make a profit in as little as a few minutes, amassing a few pips at a time. In other words, scalping the Forex market literally means taking advantage of some minor changes in the price of an asset, usually done over a very short time stretch. Scalping is a very popular style for many day traders, as it provides a lot of trading opportunities within the same day. High-frequency trading, HFT. High-frequency trading is a trading method that uses powerful and super-fast computer programs to transact a large number of orders in fractions of a second or milliseconds. It deploys complex algorithms to analyze multiple markets and execute orders based on favorable market conditions. More often than not, traders with the fastest execution speeds are more likely to make profit in the short run than traders with slower speed of execution. In addition to the super-fast speed of orders, high-frequency trading also features high turnover rates and a high order-to-trade ratio. Some of the most popular high-frequency trading firms include Tower Research, Citadel LLC, and Virtu Financial. Two primary critics fault HFT. The first is that it allows bigger institutional players to gain an upper hand in trading simply because they are able to trade in large chains through the use of algorithms. The second criticism against HFT is that the liquidity produced by this type of trading is not stable. It disappears within seconds, making it difficult for traders to take advantage of it. Also note that intraday trading and day trading have some similarities that are often discussed together. Day trading. This involves, literally, opening the market at the opening time and closing it at the closing time just after you've completed all transactions. Although day trading and intraday trading seem familiar, one observed difference is the fact that day trading deals in lower volume than intraday trading. Also, a day trader identifies a potential opportunity and cashes in on it earlier on a session-by-session amendment. In day trading, we have trends following, momentum, and range. Trend following. The weekly chart below shows the trading period of May 2006 until July 2008. The blue 20-interval period represents the exponential moving average, and it is above the red 55 simple moving average. Both are actually sloping upwards. This shows a rise of the euro, hence a weakening of the dollar. Traders trading euros at this time make profit. However, in October 2009, the 20-day moving average can be seen crossing over the 55-day moving average, and both can be seen sloping downward. At this point, the trend has changed to the downside, and short positions against the euro would be successful over any dollar value. Momentum. This is a trading strategy in which investors buy securities that are rising in the market and then sell them when they seem to have peaked. The aim is to work with the market's volatility by finding buying opportunities in short-term uptrends and then sell in the market when the securities start to lose momentum. Then the trader takes his cash and shops for the next short-term uptrend or buying new opportunity and repeats the process over again. Trading in momentum markets requires some very powerful risk management rules to address market volatility, overcrowding, and hidden traps that won't allow traders to make profits. Market players often ignore these rules, blinded by an overwhelming fear that they don't want to waste time. The applicable rules include: choose a very good liquid security. At least, the security must be one that trades over 5 million in shares per day. Never jump into a position too soon before the momentum move is ascertained. In addition, try to close the position early, after you've reached saturation point. Choose a perfect entry period. Enter the market when you observe a new wave has hit, causing rapid price movement from one level to another. Choose your holding time wisely, because the longer you stay in position, the higher the risk. Know the right time to take an exit. Range. When a trader identifies overbought and oversold areas, or support and resistance areas, and buys at the oversold area, support, while selling at the overbought area, resistance, the strategy works well in markets that are fluctuating up and down, with no equivalent long-term trend. The strategy is less potent in a trending market, but can be employed if one can account for the market's directional bias. One goal of a range trading is to find a point at which price has stretched too far, or beneath the average price, and must come back to normal, and/or to find a point where resistance or support has been established and is likely to hold again. Swing trading. Unlike intraday and day trading, swing trading usually lasts several weeks in extension, but on the average, swing trading ranges in between 2 to 6 days. Swing trading is commonly applied in equities, agricultural commodities, and forex trading. Swing trading means identifying where, precisely, an asset's price is likely to move next, entering a position, then capturing a chunk of the profit, if that move actually occurs. Winning psychology and the mindset of a day trader. Nobody wins in life without the right winning mindset and strategies. Many of today's successful traders have, at one time or another in their life, felt like they were not doing enough, or that they should not even start at all. Having these fears and anxieties are normal. What's not is letting them overweigh us, only to crowd our decision and make us indecisive. There are some benefits, attitudes, and psychological characteristics that are essential frameworks if you really want to be successful in the world of trading. Learning about trading psychology will enable traders to know when to keep their emotions and unnecessary biases in check. When you're at the peak of controlling your emotions and fear of failure, you're on your way to trading successfully. Some of the brain's associated emotions which are bad for business include too much display of happiness, getting angry unnecessarily, getting impatience, fear of the known and unknown, excessive pride, etc. How then can we improve our trading mindset? Being aware of your personality traits and weaknesses is a prerequisite to getting ahead of the poor trading mentality. Being naturally confident is okay, but overconfidence can have a negative effect. Knowing when to move and when to stop is key. You have to know when you must act and when you should not do anything at all. Biases affect the way we see and relate with things. Favoring one thing over another clouds your judgment and prevents you from critical rationalization of your intentions. When you refuse to try out new ideas, but only stick to ones that you've had success dealing with in the past, that's being biased. You must learn from failures and at the same time Be ready to check out new market challenges and adapt to trends. Let's take a look at some tips to help you have a positive mentality and right trading psychology. Be proactive and follow your trading plan. Things work well with planning. Having a feasible trading plan will help you analyze your successes and failures, which helps develop resistance to further failure. Be consistent and have a trading plan that you can follow without deviating. Have patience. It's not advisable to jump at any business without first obtaining necessary information about it. Trust your judgment while being positive that things will work out fine. Being able to adapt to trends. Things change over time. You don't want to get fixated on only one thing and lose out on many others. This is a prerequisite to develop a winning mentality. Accept your winning days and re-strategize on your worst days. Have a proper record of your wins and losses. Evaluate your personality traits and keep them in check. One of the ways to develop a winning mindset is by working on yourself and your emotions. If you understand that you get angry real quick, it's expedient that you know why and work hard to contain it going further. Winning trait of a day trader. Day trading is not for every Tom, Dick, and Harry. Without the right attitudes and personality, no one can be successful as a day trader. Do you think you have the proper traits to get ahead in day trading? Do you think you have the right wits? See some of these traits below and compare them with your traits. Persistence and determination. Persistence can break the most impervious of rocks. With determination in the right direction, you're on your way to success, not only as a day trader, but in life generally. Decisiveness. This is the ability to stand on your own and make the right decision. You don't just get bothered because your friend recently cashed out real big, and now you decided to try the same approach. You must make your own decision yourself and stand on it. Maximizes opportunity at the right time. A successful day trader is quick-witted and knows how to make use of available opportunity to make profits. Discipline. You don't want to waste your scheduled time for the day's trading on frivolities like playing video games. If you do, you should recheck yourself and re-strategize. Technology savvy. A good trader is always in the know of many of the latest software used in day trading and updates himself accordingly. Genuine interest. You cannot negotiate genuine desire. When you truly have interest in something, you tend to give it your best. Be genuinely interested in day trading market and see yourself as a successful day trader. Risk taker. You must be able to take calculated risk in business. Day trading is not gambling. Some people that really don't have any idea of how day trading works equate day trading to gambling. It is only imperative that we let them know that day trading is far off from gambling. Although it is unarguable that day trading involves a certain degree of risk, it should not outrightly be mistaken for gambling. Day traders analyze the market trend when they wake up in the morning. They thereafter open trades and close the stock the same day. Gambling involves no rationality. Day trading takes cognizance of the past performance of stocks and future expectations. Gambling does not. Day trading doesn't really care about who gains or loses. Gambling involves using cheats to derive wins. Day trading takes one step at a time to make profit. Gambling plows in deep and involves "I just want to make it now" mentality. Day trading rationalizes. Gambling thrives on feeble emotions. Day traders understand the importance of risk management. Gamblers give no risk a chance. Trading is a business. Gambling is not. Chapter 2. Starting a day trading business. Some people, especially the beginners, rush into day trading business only to rush out. They ventured into this line of business only for the sole purpose of making money quickly without investing anything at all. although there's a lot of money to be made in the business if you don't keep your guards down. But engaging in it without fully understanding the rudiments, only to think you will start making money immediately, is wrong. For every business, there are better days, and there are days you'll get hurt. Learning to balance these things is the key here. Professional and successful day traders go into day trading like it is their life. They give it all their attention without expecting any instant gratification. Unique tools of the day trading. Day trading is online with little to no physical interaction. Day trading requires you to have access to a basic internet connection, a computer, smartphones for backup internet, a phone to be able to reach your brokerage person, etc. Some other very important tools for a successful day trader include a direct access to a trusted brokerage, a real-time market data, and a trading charting platform. Desktop computer or laptop. You cannot negotiate a fast and up-to-date computer for anything when it comes to day trading business. Most software you'll be needing to run on your computers are very powerful. A higher memory is needed to be able to actively support these operations. Having 2 monitors is in fact okay, but never compulsory. Day trading charting service. Brokers want their clients, day traders, to have some software which will enable them to monitor trades on their computers. Financial charts problems are solved and explained by these software. Being able to find the best software for your trading needs and connecting them with your trading service is paramount for the overall success of your trading activities. NinjaTrader is a popular software used for trading and charting purposes. Telephone. Find a way to save your broker's number in case you want to contact them offline without using mails. Effective internet connection. Day trading involves loading many websites and data daily. Having a very fast internet connection is crucial so that you won't be found lagging sometimes when you urgently need to access some very important information. Smartphones. Your phone mobile data plan can be used as an alternative internet connection when your computer is not connecting. Just connect your phone's hotspot with your computer, and you're good to go. Brokerage. You need a brokerage to help you through your trading solutions. Financial institutions such as banks provide brokerage services, only that their commission might be too high. There are many smaller but competent brokers out there that a day trader can choose from. What you need to do is find a broker that allows you to use a specific trading software you will like to use. Day trading at different market levels may require you to use different brokers for each market. Market data. Day trading requires a constant source of financial data, especially from the market you're trading in. You will have access to timely data, only you will have to tell your broker specifically which type of financial data you want. Some brokers won't charge you for these data, but their commission will be high at the end of the day. Now, let's take a look at some of the old and latest software used in the day trading market. Trade Ideas. This is an automated system relying essentially on programmed artificial intelligence to scan series of ideas needed for startup day traders. It searches for thousands of stock ideas, carries out background research about stocks, and gives users verified stock information that can enable them to make informed decisions. The pricing ranges between $1,068 for the standard plan to $2,268 for the premium plan. There's also a free subscription that comes with few features. 2. TradingView. This is a stock analysis software. It also enables you to view different price charts used to search for multiple assets, such as cryptocurrency, bonds, commodities, futures, etc. There's a basic subscription, and there's a premium membership. Benziga Pro, first surfaced in 2010, gives users latest happenings in the financial markets, searches for background data that takes you one step ahead of the latest financial findings. 4. eSignal. one of the oldest financial charting solutions. It links you directly to many brokerage firms. 5. TC2000. This presents users with charts that are easy to follow and relate with. It also provides you with premium analysis tools. 6. Equity Feed provides you with premium tools needed to give you an edge in the market. It has the ability to search for brokers online just for you. 7. VinFix Elite provides you with some of the premium charting tools and wonderful market news. Helps you identify investment opportunities. Day trading patterns that works. Every day, you are presented with a multitude of opportunities to choose from, between thousands of available trading opportunities. This is due to a wide range of factors influencing the day trading markets. Day trading patterns enable you to decode multitude of options and motivations, including hope of gain and fear of loss, short covering, stop-loss triggers, hedging, tax consequences, etc. Candlestick patterns help you by giving you a vivid picture and revealing to you trading signals and signs of future price movements. Whilst it is unarguable that you will need to exploit some technical analysis to succeed day trading with candlestick and other patterns, it is equally pertinent to reinstate that utilizing them to your advantage is more of an art and should be imbibed. Here we will talk about some popular day trading patterns, including breakouts and reversals. Your own is just to identify the best patterns to assist your trading style and methods. Breakout occurs when the price clears a specified critical level on your chart. This level could be any number of things, from an advanced level to support, resistance, or trend lines. A breakout is usually identified as a potential trading opportunity that occurs when the price of an asset moves above a resistance level or moves below a support level on incremental rate. The first thing you should know in trading breakouts is how to identify current price trend patterns along with support and resistance levels so that you'll be able to plan possible entry and exit routes. Once you've taken action on a breakout report, you must then determine when to cut your losses and assess the situation again if the breakout sputters. A breakout trader can enter a long position after a market's stock price breaks above resistance or enters a short position after stock price breaks below support. Once the stock trades beyond the price barrier, volatility tends to increase, and prices usually trend within the breakout's region. The reason breakouts are very important trading strategies is because they form the framework for future volatility increases, large price swings, and in many circumstances, noticeable price trends in the market. Breakouts typically dominate all types of market spaces. More often than not, the most noticeable price movements are the ones resulting from channel breakouts and price pattern breakouts, such as triangles, flags, or head and shoulders patterns. As volatility contracts during these time patterns, we'll have expansion after prices move beyond the identified ranges. The graph below represents a triangle breakout curve. When trading breakouts, it is pertinent to consider the prevailing stock support and resistance levels. The more times the stock price touches these areas, the more valid and profound the outcome. Reversal. This is just a change in the direction of a price trend, which could be either positive or negative, against the prevailing trend, also called a trend reversal. Certain indexes, such as moving average, oscillator, or channel, may help in identifying trends as well as understanding reversals. Reversals identify large price changes whenever the trend changes direction. Small countermoves against these trends are called pullbacks or consolidations. Reversals are often common in intraday trading and happen rather very fast, but they can also occur across days, weeks, and years. Reversals occur on different time frames, which are particular to different traders. An intraday reversal on a 5-minute chart doesn't especially matter to a long-term investor who is on the lookout for a reversal on a daily or weekly chart. Yet the same 5-minute is very important to a day trader. An uptrend, a series of higher swings high and higher swings lows, snaps back into a downtrend by reversing to a series of lower highs and lower lows. A downtrend, a series of lower highs and lower lows, snaps back into an uptrend by reversing to a series of higher highs and higher lows. The chart below indicates an uptrend moving with a channel, making a series of higher highs and higher lows. The price breaks out of the channel initially and below the trend line, indicating possible trend change. The price also makes a lower low by dropping below the prior low within the channel. This further validates the reversal to the downside. Candlestick chart. The patterns are pretty straightforward to interpret. Also, trading with candle patterns can help you attain that competitive edge over the rest of the traders in the market. There are about 3 most popular candlestick charts that are most commonly used. These include shooting star candlestick, doji, and hammer candlestick. Candlesticks work by building patterns that can predict price direction once completed. A candlestick displays information about an asset's price movement. Candlestick charts are one of the most widely used components of technical analysis, allowing traders to interpret price information quickly through analyzing just a few price bars. A hammer can be used to show when there were selling pressures during the day, but a strong buying pressure later drove the price back up. The color of the body can vary from green to red, but a green hammer indicates a stronger bull market than a red hammer. Technical analysis indicators. Using trading indicators is part of day trading technical strategy. When combined with the right risk management tools, it could help you gain more understanding of the price trends. Trading indicators are mathematical calculations, usually plotted as lines on a price chart, and can help traders extrapolate signals and trends within the financial market. Leading indicators provides users with future price fluctuations. Lagging indicators studies past trends and indicates exciting momentum. The following are some of the identifiable trading indicators. 1. Simple moving average, SMA indicator. Used to extrapolate the direction of a current price trend without any particular interruptions from a shorter-term price spike. The SMA indicator simply takes the price points of a financial accessory over a specific period and then divides it by the number of data points to present a single line trend. The data used actually depends on the length of the MA. For example, a 100-day MA requires 100 days of data. By using the MA indicator, you can determine possible future patterns. 2. Exponential moving average indicator, EMA. EMA is another type of moving average indicator, but unlike the SMA, it factors huge attention on recent data points, making data to be more responsive to new information. When rightly combined with other indicators, EMAs can help day traders analyze significant market moves and determine their legitimacy level. We have the 12 and 26-day EMAs for short-term averages, whereas the 50 and 200-day EMAs for long-term trend indicators. 3. Stochastic oscillator. This is an indicator that compares a particular closing price of an asset to a range of its prices over time. It employs a scale of 0 to 100. A reading of below 20 indicates an oversold market, while a reading above 80 shows an overbought market. 4. Moving average convergence divergence indicator. Helps traders identify potential buy and sell opportunities within support and resistance levels. Convergence stands for when two moving averages are coming together, while divergence stands for when they're moving away from each other. If moving averages are converging, it indicates momentum is decreasing, whereas if the moving averages are diverging, it shows that momentum is increasing. 5. Bollinger Bands. Bollinger Bands are useful when you want to know when an asset is trading outside of its normal levels, and are used most times as a means for predicting long-term price movements. 6. Relative Strength Index, RSI. RSI enables day traders to identify exciting momentum, market conditions, and warning signals for dangerous price fluctuations. RSI is usually rated between 0 and 100. When an asset is around the 70 level, it is often considered overbought, while an asset at or very close to 30 is often regarded as oversold. 7. Fibonacci retracement. Used to confirm whether there will be a move in price. It is an indicator that can show the extent to which a market will move against its current trend. A retracement occurs when a market undergoes a temporary dip, also known as a pullback. Effective steps to starting out a day trading business. To become a successful day trader, you need to have a well-enough capital base and have access to a moderately cheap and functional trading platform. The right trading mentality must be in you, otherwise it will be somehow difficult to navigate your way successfully into the day trading niche. A perfect understanding of market trends, financial securities, and behavioral psychology, alongside personal discipline and determination, are prerequisites for success. The following are some of the thoroughly researched steps to becoming a successful day trader. 1. Conduct a thorough review of your personality. Ask yourself, do you have the right mindset? Can you work for longer hours doing research on the internet? Are you financially inclined? Are you a risk taker? Are you committed and dedicated to your purpose? If your answer is no, I'd advise you to consider another niche for now. 2. Have a large capital base. This is so that if you run at a loss, you can still continue in the business. If you don't have a solid capital plan, your plan of becoming a successful day trader might fail. 3. Have a broad knowledge base relating to the financial market. 4. Understand trading and securities requirements. 5. Have a feasible trading strategy and be adaptable. 6. Know how to manage your resources, money especially. 7. Know much about brokerage services and plan ahead. 8. Don't invest all your worth. Begin small and grow in the process. Steps to building a winning trading plan. There's the cliché expression which has usually found its way into the lips of all and sundry. If you fail to plan, you have already started planning to fail. It is safe to say nothing works without proper planning. If you can imagine the level of planning that went into building the Eiffel Tower into what it is today, only then can you know planning brings beauty. It is equally important to say, just like every other thing in life, day trading requires sincere planning and dedication to progress. If you already have a workable plan to start your day trading career, it is all good. But if you don't have such yet, you're not late. Though your plans should not be entirely set in stones. That is, it must be one that is flexible and can adapt to market trends and fluctuations. Follow these steps. 1. Know your skills set and be ready to leverage on them. 2. Be emotionally, psychologically, and financially ready. Don't be discouraged. 3. Don't invest all your earnings. If you have $50,000 US, you can set 30% for business. 4. Research your markets. You don't plow into anything that you don't really understand, otherwise you risk being burned out. 5. Set your targets. Know what you're expecting at the end of the day and the strategy to achieve them. Chapter 3. Different Day Trading Strategies. A day trader strategizes to capitalize on frequent, small price movements in the market. So if you're here looking for effective strategies that work, you're on the right path. That's what you're supposed to be doing anyways. A consistent and workable strategy thrives heavily on thorough technical analysis, using charts, indicators, and strategies to predict expected and unexpected future price changes. You don't really need a highly complex strategy. The simpler your strategies are, the more feasible they are. Everything all boils down to planning. When making that decision on what stock to trade in, you'll do well to capitalize on these three things. Market volatility. The more volatile your chosen market is, the more your chances of cashing out real time. Cryptocurrency has, over time, turned out to be one of the most volatile day trading markets. Stock volume. High stock volume is indicative of the fact that people are interested in that particular stock. If stock increases unexpectedly, it may be an indicator that the price will go up or come down soon. Liquidity. High liquid assets such as gold or crude oil trade fast. The following are some of the most trusted day trading strategies, which have already been discussed in Chapter 2. Here, we'll only take a look at their general overview. 1. Breakout. Every price adjustment in the market can be explained in two ways. A. Range consolidation. This occurs when prices move sideways, high or low, accumulating orders as it gets established in the market. B. Range expansion. Occurs when price moves away from the consolidation range, breaking into a new area of interest. These are the key concepts of price exploration and price discovery. To become a successful day trader, you must be able to identify when price has consolidated enough and is likely to enter the expansion phase. This is the breakout. There are about 4 basic chart patterns for breakout. Channel pattern. Buyers accumulate price at the high lows, and sellers are filling up the highs. Head and shoulder pattern. Flag pattern. Buyers and sellers are accumulating their positions in anticipation of price falls. Wedge formation. 2. Scalping. This is actually one of the most popular strategies used in the market, especially in the Forex market. This technique capitalizes on minute price fluctuations. You will need to watch out for the moment the business becomes profitable and then sell out. In addition, you must be on the watch for volatile instruments, attractive liquidity, and be quick on timing. You can't wait for the market to come back to normal. You have to learn to immediately close losing trades as soon as possible. 3. Pivot point. This strategy is great for identifying critical support and/or resistance levels. Its use is of utmost importance in the Forex market. A pivot point can be defined as a point of rotation. Traders use the prices of the previous day's high and low, and then edit with the closing price of a security asset to determine the pivot point. Pivot point can be calculated by pivot point P equals high price plus low price plus closing divided by 3. The support and resistance levels can then be calculated using the pivot point. These formulas will be applicable. First resistance, R1 equals 2 asterisk P minus low. First support, S1 equals 2 asterisk P minus high. The second level of support and resistance can, however, be calculated as follows. Second resistance, R2 equals P plus R1 minus S1. Second support, S2, equals P minus R1 minus S1. 4. Reversal. Although not advisable to be used for beginners, reverse trading is very popular all over the world. It can also be called trend trading. This strategy involves trading against the trend by identifying potential pullbacks in the market and matches them against their strength. 5. Momentum. This strategy is effective for beginners. Revolves around staying updated about new earning news and capitalizing on them appropriately. Important resources to aid day trading and improve your strategies. Online videos. Shop online for great videos to learn about strategies and essential requirements of day trading. These videos are available free online, and you don't even need to pay to watch most of them. Videos provide you with relatable contents while demonstrating techniques using visible graphs and charts. eBooks, the most readily available tool to learn more about almost anything, not only day trading techniques, is eBook. You can download eBooks with less data and read them at the comfort of your house. Even while relaxing on your bed, eBooks provide you with raw facts about day trading techniques, showing you how and why everything works. An overwhelming majority of people prefer to learn through digesting eBooks. One of such is this beginner's guide you're currently reading. Blogs. Learning day trading techniques just by clicking on some websites is amazing. Forums. Online forums are easily accessible to ask questions and make comments. Planning and executing day trading strategies. 1. What period of the day will you adopt? You'll have to be able to identify what works better for you. Some people trade between 8 a.m. till 9 a.m. and were still able to meet targets better than one who traded between 8 a.m. till 2:30 p.m. It all boils down to how effective you can be at some period of the day. 2. Master less strategies at a time. Jack of all trades, master of none. Never forget this. People are mostly very effective at doing one thing at a time. Multitasking sometimes leads to divided attention. Have a list of all you want to do for the day, week, or month, and routinely follow them to meet your targets. 3. Identify your trading styles and what stock to trade in. You must be able to identify stocks that are in high demand in the market. Identifying stocks that have the highest rate of profitability is essential here. Trade in stocks that have the potential to grow and dominate the market pyramid, even in years to come. 4. Have a stop loss. You're not advised to continue trading even when the market forces are obviously against you at the moment. You must have a stop loss to help you gauge what amount of loss you can bear. When you reach that threshold, you should stop. Otherwise, you risk losing everything. 5. Even when you're winning, know when to exit. Sometimes you may be tempted to keep trading, having observed some consistent wins. You must know when to exit so that you won't eventually lose all that you've won. 6. Decide on how much money you'll be using per trade and stick to it. 7. Measure your performance and your strategies. 8. Conduct a series of sample trades to evaluate your performance. Chapter 4. Things to look out for when selecting a broker and trading platform. Choosing the right broker for your trade can be a great deal to determine your success in day trading business. There are many brokers out there, but your own job is to select one or two that fit your ideal. There are basic things that should be prioritized when selecting a broker for your trade. Things such as platform features. Does his platform allow you to do your thing without hassle? Business security and charges should be the top priority for you. Choosing the best online broker for your business requires some level of understanding of key criteria. Let's take a look at those things you must do first to make sure you're on your way to selecting the right broker. Identify what you need. While experienced traders may prioritize advanced charting capabilities, conditional order options, and the broker's ability to trade in derivatives, mutual funds, commodities, and fixed income securities, beginners may not necessarily be looking for these features. Things like basic training resources, comprehensive glossaries, access to support staff, and whether the broker can allow you to practice trades before you start playing with real money should be the top priority for beginners. Narrow your search. You can't be all out searching all available online brokers in all of the available online resources. You must be on the lookout for brokers that are members of some recognized professional bodies, such as Security Investor Protection Corporation, SIPC, Financial Industry Regulatory Authority, FINRA. Is the broker insured by the Federal Deposit Insurance Company, FDIC? Can the broker guarantee you protection against fraud? Does the broker have working technology in place to keep your account safe? These are the questions you should be asking yourself. Figure out what the broker's commission is. Of course, you don't want to spend half your earnings paying commission to brokers. Identify how much he charges, and then figure out if you can afford it. Test run the broker's platform. Although many brokers would have already listed out what features their platform can provide, it won't be a bad idea if you decide to confirm by yourself, especially if the broker allows you to create a free account for that purpose. Ensure that you have a preliminary access to most of the tools. Even if you can't access the broker's collection of premium tools, a look at his most basic tools will tell you something. Ease of withdrawal and depositing funds. How easy will his platform give you the chance to move money in and out of your account? Ease of seeking help on the platform. Does the broker have excellent customer service on his platform? In any case that you're stuck, are there readily available technical consultants to help you? Is there a dedicated number you can call to speak to a human for trade assistance? Make sure you are aware of any additional fee to be paid if you call help. Is there any automated number that you can just contact for basic queries? Can you seek general help? What are the call-in hours for representative assistance? What are the specific hours of operation for the phone lines? Can you call at any time of the day? Or are their phones only available during normal business hours? For those who really don't like calling, is there an email address they can use if there's any query? How effective is even the platform's search function? Some popular trading platforms. Some of the very popular trading platforms include MetaTrader 4, MetaTrader 5, NinjaTrader, TradeStation, and CTrader. MetaTrader 4. As of now, MetaTrader 4 is the most used platform across brokers and the most discussed across retail trade platforms. It packs in all the features which a trader desires and is especially user-friendly. Some beginner brokers find it very easy to explore and even cheap to set up and maintain as well. They have a top-notch customer service and support team, which helps the brokers to sort out any minor issues experienced on the platform. Advanced users and large traders do not trust the platform for high-speed execution of their tasks, as they believe it slows down the order execution, and also has features which favor the broker more than it favors them. MetaTrader 5. MetaTrader 5 was packaged by the same company that branded MetaTrader 4, and the biggest advantage that the new MetaTrader 5 version has over the former version is the fact that it can be integrated easily with stock and option trading. MT4 was more for the Forex market and was difficult to incorporate into the stock markets, but MT5 can be incorporated into stock trading, and it was also observed to be much faster in terms of executing orders. TradeStation. TradeStation is the choice for large traders and fund managers, as it features very high speed of execution, and the technology involved is in fact superb. For beginners, it is not particularly user-friendly, but larger traders enjoy it for the speed and reliability. NinjaTrader and CTrader. NinjaTrader and CTrader are perhaps the oldest platforms in the market and are still loved by a subsection of traders for their user-friendliness and their mouth-watering offer. They have some exceptional order type, and users can leverage on this to have a wide choice of varieties. Robots. These days, there's always the place of artificial intelligence, AI, in everything we do. Artificial intelligence, in the forms of robots, are programmed to make the job of traders a bit easier. There are trading robots which help the trader to sort trades automatically, with the trader only having to do so a little. One of the most commonly used is a robot named FAP Turbo. Like all robots, it has received mixed comments from users, as it tends to work differently in different trading conditions. The drawback of many robots is that they find it difficult to adapt to the changing market conditions, and they have no inbuilt program to understand what works today might not work tomorrow. The FAP Turbo, though, has stood the test of time and has been consistently doing its best. Charting software. There are many charting software online which traders find exclusively interesting and easy to use. Charting software are essentially important to carry out technical analysis. Thus, it becomes very imperative for the traders to have a charting software that they are most convenient using, and which features all the tools they are likely to use while day trading. The Auto Chartist charting software has several features, which includes pattern recognition, which enables traders to analyze their patterns easily so they don't waste precious time trying to do it. This allows traders to make better and informed trading decisions. Ultimately, the success of a day trading business depends entirely on the trader and how comfortable he is using the platform and software that he uses. Although these can help to improve the trading decisions made, it therefore becomes expedient the trader chooses the right platforms and software, as trading is a difficult job in itself. Chapter 5. Trading Options. What is an option contract? In a very simple analogy, options trading involves buying and selling options contracts on the public exchanges or market. Actually, this trading is very similar to stock trading. However, while stock trading thrives on making profits through buying of essential stocks and selling them at a higher price, options trading only ever involves making profits by buying options contracts and selling them at a higher price. While stock traders can stop taking their chances on stock that they will suspect will go down in value, options traders can do the same with their options contracts. To be more concise, option trading is far more versatile than stock trading. For one thing, the obvious reason that options contracts can thrive on a wide variety of underlying securities means that there's plenty of scope to decide how and where exactly they are going to invest. Options traders can use options to predict the price movement of individual stocks, indices, foreign currencies, and commodities, among other things, and this obviously makes them prone to more opportunities for potential profits. The real versatility comes in terms of the various options types that can be traded in real life and the range of different orders that can be placed and choose from. There are two most recognized ways of making money when trading your stock. Either you take a long position or a short position on a specific stock. If you speculated that a particular stock can go up in value in future, you are likely to take a long position by buying that stock with the mindset to sell it later at a higher price. Also, if you observed that a particular stock can go down in value, then you are much more likely to take a short position by short selling that stock with a hope of buying it back later at a lower price. Getting started option trading. There are two major ways in which you can sell options contracts. 1. If you have a contract at hand and you want to really make your gains or cut your losses, then you would likely sell them out by simply placing a sell to close order. An order is named as such because you are closing your position by selling options contracts. You would usually use that order if your contract had gone up in value and you wanted to cash out and make your profits at that moment, or if your options had depreciated in value and you wanted to leave your position before incurring any other losses. 2. The other way you can sell options is through opening a short position and short selling them at market prices. This is also called writing options, because the process actually entails you writing new contracts to be sold in the market. When you do this, you're taking on the necessities of the contract. Also, there are ways to write options. You can write options by using the sell to open order, and you would receive payment at the time of placing such an order. This is actually riskier than trading through buying and then selling contract. But there are profits to be made eventually if you give it a try. You would usually place such an order if you are sure that the player underlying security would not fluctuate in such a way that the holder would be able to solely control the profit. For example, if you are convinced that a particular stock was going to either remain static or fall in value, you could devise a means to write and sell call options based on that stock. You would be at the verge of potential losses if the stock did go up in value. But if the stock did not go up in value by the time the options expired, then you would keep the payment you received for writing them. Unique strategies used in option trading. 1. Covered call. Let's say you buy 500 shares of a regular stock, and then you sell one call option per 500 shares of that stock. This strategy has been consistent in helping traders reduce the risk of their current stock investments and also provides them an opportunity to make profit within the option. Covered calls can increase your profit when the stock price increases or stays fairly constant over the time period that the option contract will last. However, traders can still lose money with this kind of trade, especially if the stock price falls too much, but can actually still make profit if it only falls a little bit. 2. Straddles and strangles strategy. The straddle strategy involves the trader buying a call and put option at the same strike price, underlying price, and expiry date. This strategy is often used when a trader is expecting the stock of a particular company to increase or decrease, which usually follows an event like an earnings report. For strangles, an investor will procure an out-of-the-money call and an out-of-the-money put simultaneously with the same expiry date for the same underlying asset. Investors who use this strategy are relying on the probability that the stock will have a dramatic price movement, but don't know in which direction and to what extent. Chapter 6. Forex and Day Stock Trading. Day Trading, Forex. Forex is a code for foreign currency and exchange. Most countries of the world use different currencies for their everyday transactions. But money must circulate, hence the need to trade in currency. To trade currency between nations, there must be a system that can convert one currency to another. Foreign exchange is simply the process of converting one currency into another currency for a number of reasons, mostly for the purpose of commerce, trading, or tourism. When we talk about a global marketplace for exchanging currency against one another, we talk about foreign exchange, also coded as Forex or FX. Because of the worldwide extension of trade, commerce, and finance, foreign exchange markets seem to be the largest and most bankable asset markets in the world. World currency usually trades against each other as exchange rate, e.g., EUR/KWD, EUR/dollars. Currency has to be traded in order to engage in international trade. For instance, a tourist from France who arrived in the United States needs to exchange his euro with United States dollars for him to pay for his hotels and food. This is because the euro is not approved trading currency in the U.S. foreign exchange market and doesn't really have a physical market where traders meet to carry out transactions. All transactions between buyers and sellers are done via the Internet. The market is opened 24 hours a day, and currencies are being traded across all time zones. Commercial and investment banks often act as middlemen trading in the Forex markets on behalf of their clients who've consulted them. There are also opportunities for trading one currency against another currency for professional and individual investors. Why trading in currency has been so easy now. No doubt that the technological advancements of the 21st century has contributed to the ease with which we get things done now, more than ever before. The invention of ultra-fast computers has equally advanced the course of Forex, bringing everything to the forefront. Trading in currency was a Herculean task for individual investors before the Internet age. Those days, most currency traders were large multinationals, hedge, or high-net-worth individuals, because the market was highly capital-intensive. With the advent of the Internet, a target market aimed at individual traders has surfaced, providing easy access to the foreign exchange markets, either through the banks themselves or brokers making an outside-the-bank market. There are now many online brokers who can advance Forex even for traders with little money. Forex is the largest market in the world, and therefore it's always liquid. Money enters the market every minute and seconds. Money also leaves it the same way. This makes it especially very easy for any trader to enter and leave his position. But there are extreme levels of leverage, which has led many traders to becoming bankrupt very quickly. Forex market is being run 24 hours, but it requires a thorough understanding of economic issues and financial spaces. Forex day trading strategies. While there's no one-size-fits-all rule in life, the best Forex strategy is actually the one you experiment yourself out of the many strategies available. You have to highlight your personality and understand the best Forex strategy that will work for you. What worked very well for your best friend might be the worst nightmare for you if you try it. In the same vein, what doesn't work for others might just be the right dose for you. It all boils down to trying without getting tired. Here are some strategies below. 1. 50 pips a day Forex strategy. This strategy exploits early market fluctuations of some particular high liquid currency pairs. The British pound US dollar and euro US dollar currency pairs are among the best currencies to trade using this particular Forex strategy. The profit target under this strategy is usually set at 50 pips, and the stop-loss order is mostly placed anywhere between 5 and 10 pips. 2. Forex 1-hour trading strategy. This strategy makes use of the 60-minute time frame. Some of the easiest currency pairs to trade using this strategy are the euro US dollar and the US dollar Japanese yen. You would, most of the time, need a 100 pip momentum indicator and indicator arrows, which are very much available on Metadata 4. 3. Forex trading weekly strategy. Forex weekly trading strategies can give more flexibility and stability over the in-trade strategy. A weekly candlestick provides extensive market information. 4. Trend following Forex trading strategy. When a market breaks out of a range, moving below the support or above the resistance, a trend usually results. When support breaks down and a market moves to new lows, buyers won't buy for the meantime. They will always want to wait for the steep to fall to the bottom low before investing their cash, owing that things become cheaper at this point. There will also be some traders engaging in panic buying, and some of them might even be forced to vacate their long-standing position. Trend-following strategies make traders to invest their money on markets once they have been able to break through resistance and sell markets, and also when they have fallen through support levels. In addition, trends can be dramatic and linger too long. Because of the level of systems involved, this type of system has the potential to be the most successful trading strategies. Features of Forex day trading. There are many features of Forex day trading which include 1. Non-stop trading. Trading is continuously in operation as long as there's a market open in any part of the world. 2. Tight spreads. With a tight spread, you can be charged less for each trade. Forex market involves high trading volume. You could be able to avoid less slippage. Slippage occurs when you click on a particular market price and another one appears just after you've ordered the previous one. You can leverage on tight spread to help reduce the level of slippage. Flexibility and convenience. Forex trading software is available for downloading on phones, which gets you online every time. 4. Fractional pips provides more accurate and tighter spread with better liquid and less slippage. 5. Trading at your convenient time. FX runs 24 hours a day, even on Sundays. This gives you time to work on any day and at any time. Day trading stocks. Stocks are the capital raised by a company through trading of shares. Stocks are real long-term investments, but it can still offer opportunities for day traders who want to make maximum daily profit. They only need to have the right plan. Stocks trading today has become a dynamic and exhilarating investment. Stocks are easy to buy and sell. With the advent of sophisticated computers and the Internet, the market is now widely accessible. Day trading versus stock trading. Intraday trading usually takes at least a couple of hours to minutes each day, and you have to be very conscious to have your trade very early in the morning when the market is booming. However, longer-term stock investing normally doesn't take up time as much as forex trading or intraday trading. Short-term trading stock is usually harder, especially if you focus on more than one stock at a time. The reason is partly due to the fact that intraday trading involves interpreting the stock ticker and spotting gaps over the long term, which seem far easier. You also don't have to be hasty while making decisions. The perfect time to day trade stocks. Timing is applicable in almost everything in life. Likewise, in the day trading stock business. If you don't know the best times to trade stocks, you may find day trading stock very difficult. You should find the following tips easy. Don't wait too long to get started. Remember, procrastination is the thief of time. You should have a habit of waking up early in the morning, arranging your workstation, and starting your daily activities. Trade in short bursts. Sometimes it's not until you trade for an 8-hour stretch before you make that big profit. Trading for 2 hours to see a return of $800 is better than day trading for 5 hours only to realize $800. Strategies for day trading stocks. Stock day trading strategies will most times fall into any of these categories. Scalping, trending and ranging. Scalping includes all trades where the stock trader makes a profit, leveraging on order flow, such as calculating the spread, collecting ECN credits, or riding the coattails of a large order. Trending includes all strategies where the trader makes profit from a balanced move in price in one direction. Ranging strategies are used when the market instability is moving between resistance and support. Profits are made during this movement, rather than on a stock making new highs or lows, as in trending strategy. When these three strategies are combined, they yield results which are more likely to be profitable at all times, without hassle. Chapter 7. Secrets of Success in Trading. The appropriate time for trading. There are several trade periods in a day. We have the morning, afternoon, and night. Each of these periods should be utilized well to have a successful day trading business. For instance, Forex day trading runs 24 hours a day, so if you enter the market around 3 p.m. or 1 a.m., you'll still do your business. The morning is a big player in day trading market because of its volatility, and bigger moves are recorded during this period. This means a trending type strategy is much preferable. The trader may have to aggressively enter the market, remove liquidity positions, so that he will not miss out on the largest and/or quickest moves for that day. Periods between 11 a.m. and 1 p.m. Eastern Standard Time is most time the lunch period. It's usually a very quiet time. The market generally experiences smaller moves in business, decreased volume, and the market is not particularly liquid at this time. This is a time where traders should be more determined on adding liquidity at the extreme edges of the established range, or even slightly higher. While there are exceptions, most days will not require removal of liquidity to enter positions during this time. Rather, traders should wait for the price to come to where they want it, and if it doesn't, don't bother to make the trade. Trades will not likely be much during this time, due to the reason that there is less volume, and trades are more likely to get prolonged than in the morning or later in the evening or afternoon. Therefore, traders should make sure their reward risk compensates them for the stress. Periods around 1 p.m., after lunch, will usually experience spike and increase movement as the traders return to business. The breakouts from lunchtime ranges can be very quick and somewhat aggressive. Therefore, you must endeavor to exit losses quickly and then move to a trending strategy. You still require a bit of patience here. Exit losses quickly and attempt to see where the trend is actually moving toward the close. Try as much as possible to remove liquidity if required. But since moves may still be questionable, add liquidity when possible until you're sure that a definitive trend emerges. The 3 times of day can be summarized below by the aggression style that should be used to trade them. Morning. Aggressively join momentum moves that are fresh for the day. Removal of liquidity is often necessary. You can use tight stops, since a change in direction can happen swiftly. Noon. Very conservative. Use the range trading type strategies. Always try to add liquidity unless a loss is escalating. Be very patient. Let price come to the order first, instead of removing liquidity to enter a position. Afternoon. Watch for breakouts experienced during the lunchtime range, if there actually was one. Join trending moves and attempt to add liquidity if markets remain quiet. You should exit noon trades quickly if the price moves specifically against those positions in the afternoon. Look out for points where the morning trend is likely to reemerge or reverse and capitalize on them. When to change your strategies. The times of day outlined above are only rough approximations. What is really important is noticing when the market changes from ranging to trending and vice versa, and then adjusting to it appropriately. In the morning, there is high volume of trade at the start, which increases as the trend accelerates. In order to capitalize on a move like this, the trader needs to be aggressive, removing liquidity as much as possible to get on board with the trend. As the day progresses, by 11 a.m., a range must have been established, with a false breakout occurring after about 30 minutes. At this point in the day, though, a trader should reduce his aggressiveness while adding liquidity and focusing his time and resources more on a range-type strategy until the market gives signals to change it. Volume is declining, and false breakouts should be expected. Therefore, the trader can see this breakout as faded rather than as of a trend. Just after 1 p.m., the market breaks lower. Volume has still not spiked up, so there's no need for a trader to get aggressive on entering the market. Through the afternoon, traders are advised to combine patience and a trend-following strategy, if a trend actually develops. Otherwise, they will stay with the conservative ranging strategy, waiting for entries into the overall trend. Creating passive income with day trading. If a trader is aiming to generate passive income with day trading, that means he's not planning to be spending all day on his computer monitoring the market strategy and the market trades. Unlike active traders, passive traders' income will fit around their lifestyle rather than actually dictate it. Passive income entails consistently making money that requires only a small effort on the part of the trader to earn and maintain that money. Income generated through stocks, interest rates, commodities, lottery winnings, and capital gains are often the types of income that people talked about while discussing passive trading. Traders don't necessarily need to invest a whole lot of their time. This seems like a benefit, right? When you have time to spend on other things going on in your lives. However, this also means that you have to be making your investment decisions real quick. One observed disadvantage is that passive trading can at times result in a low profit when matched against active trading. Some traders also neglect monitoring their passive income through procrastination, which often results in a big loss for them. Risk management and the one-person rule. Successful people today had, one or two times in their lives, taken calculated risk. Knowing when and how to take the risk may be the big difference between a successful person and a loser. Risk management helps tailor your needs, cutting down your losses in the process. When a trader understands risk management perfectly, he's able to make intended and informed decisions that will be beneficial in the long run. It can also help you as a trader to protect your account from losing money. Risk, when properly managed, has a tendency to open the trader to making money in the market, whether online or offline. A trader who makes $1 million today can lose it all today or tomorrow if he doesn't have a proper risk management strategy. Scary, right? You don't have to be scared. This book is here for you to teach you all that you need to know. Let's take a look at some of the strategies that can protect you. 1. Planning. Yes, that's right. There's a particular expression that you can usually find on the lips of most successful traders. Plan the trade, trade the plan. It is unarguable that any business without planning is bound to run down the same way it started. Planning is effective to get most things done in life. Successful traders always gauge the price they're paying in the market with the price they're selling. If the return is moderate, they carry on with the business. If it is not, they stop. Unsuccessful traders, on the other hand, enter the market without having the basic idea of what to even buy or sell. You must take your time and do your research well. The stop loss and take profit points are two ways a trader can plan accordingly. A. Stop loss. This is the price at which a trader will sell a commodity and incur a loss. This usually happens when the business fails to go as planned. If you, as a trader, are holding some stocks ahead of earning as excitement builds, you may want to sell before the news enters the market if expectations have actually become too high, regardless of whether you have hit the take profit price or not. B. Take profit point. This is the amount at which a trader will sell his stock and make a profit on the trade. This is when the risk has already limited any additional upside. For instance, if a trader thinks that a stock is already approaching a key resistance level after a large move upward, traders may resort to selling before a period of consolidation occurs. 2. Never put all your eggs in a single basket. This advice should be followed thoroughly and taken to heart. If you invest all of your money in a single business, you're already setting yourself up for loss even before getting started. Diversifying your investment is key here. It helps you manage your risk. It also helps you open up to more profit opportunities. 3. Plan the entry and exit route before getting started. In the case that you run at a constant loss, having a new strategy to keep you ahead is essential. Knowing the right time to invest and the right time to quit is also an essential requirement. What is the 1% rule? The 1% rule presupposes that you should not invest more than 1% of your earnings in a single trade. Let's say you have $5,000. You should not invest more than $500 in a single business. This is one effective risk management skill everyone should have. To use the rule better, always ensure that you pegged your investment below 2%. Money management. The act of managing resources is applicable across all facets of life, not only in business. When you plan every savings, budgeting, spending, or investment, you're already doing money management. In the financial space, money management is often referred to as portfolio management. Large corporations often hire the service of financial advisors to help them manage their spending and investment portfolio. Nowadays, with the growing trends in financial technology, there are software that users can adapt and can help manage individual spending portfolio. A money manager is someone or a firm that manages every financial obligation for an individual or another firm. In stocks and futures trading market, money management is essential in the success of a trading system. This can be gauged with trading expectancy. Expectancy connotes the average amount you can opine to win or lose per dollar at risk. Mathematically, expectancy equals trading system winning profitability, asterisk, average win, minus trading system losing probability, asterisk, average loss. The following key point can help you manage your money effectively. When making decisions, always go for the most cost-effective option. Shun any spending on unnecessary mundane things. Most of your spending should be on things that can yield returns, whether financial or otherwise. Invest your money as much as possible, but invest wisely. Spend on fixed assets. Common trading mistakes you should avoid. The day trading platform, ranging from Forex to intraday trading, has been so overwhelmed nowadays, owing to the little barrier placed on entry. Now anyone with access to a computer and fast internet connection can think of having a Forex platform. Whereas these trains are not for the faint-hearted. If you enter the market with little or no information at all, you will burn out as fast as you rushed in. Therefore, before you think of starting day trading, consider these common mistakes and avoid them as much as you can. 1. Avoid trading without having a stop-loss set up. Stop-loss allows you to gauge what point it is advisable to leave the market. The stop-loss will prevent you from losing money that you cannot handle. 2. Avoid risking everything on one endeavor. Use the 1% rule to your advantage. With that, you risk losing only 1% of your earnings, if the loss is unavoidable. The remaining part of your earnings can still be invested in other businesses. 3. Don't rush in. Go steady. Sometimes, when you lose money, the hurt will most likely want to tempt you into going by force and investing more to cash out big. Don't be tempted. Just go steady, and you're on the right path. Stay true to your risk management strategy. 4. Don't choose the wrong brokers for your trade. Sometimes, some brokers use a click and bait strategy to lure you into trusting them with your money, whereas they're only planning a scam. Such bait can be in the form of luring you with discounts and bonuses. Don't be the victim of a scam. Research well about every broker you come in contact with before you establish relationships with them. 5. Don't risk correlated multiple trades, all in the name of diversification. Some trades are identical in lines and strategy. Losing out in one can mean losing out in the other when you invest your money in the two of them. 6. Don't trade without your trading plan. A trading plan is the how and why of your business. It provides you with a clear strategy of how to invest your money and what return you should be expecting. If you plunged into day trading without a plan, you'll get burned. 7. Don't lose patience. Everything good takes time to manifest. If you're the type that loses your calm easily, try and change. You must not lose your patience. 8. Avoid instant gratifications. Some people believe in getting there and getting rich quickly in the same day. Don't be like them. 9. Don't keep trading if you're losing money consistently. 10. Avoid conflict of interest.